Money FM 89.3. Best of breakfast. The U.S. Market Update with Money FM 89.3.
That's right. Welcome to the U.S. Market Update. I'm Emaad, Akhtar. It was yet another rough day stateside. Stocks fell broadly on Thursday. The S&P 500 sliding for a fifth day running as traders took to Fed Chair Jerome Powell's speech on Friday at Jackson Hole. The broad market index shed 0.4%, closing at 6,370, while the Nasdaq Composite slid 0.3% and settled at 21,100. The Dow Jones Industrial Average fell as well by 0.3%, ending at 44,785. So investors are looking to hear from Powell at the central bank's annual economic symposium, where he could offer insights into the path of interest rates that could offer some reprieve about persistent inflation concerns. Let's analyze all of that and more with Ryan Detrick, Chief Market Strategist at Carson Group. Ryan, how are you?
I'm doing well. Thank you for having me back and appreciate the opportunity today.
Yeah, Ryan, it's been a difficult week for tech stocks, and that continued on Thursday. What's going on?
Exactly. The S&P 500 is actually down 5 days in a row. And I'll be honest, at least on the S&P 500, they're all pretty small, like little tiny cuts, but still down 5 days. But we've seen tech down more. And the big thing is, is there some major news, major reason? I don't think so. I think it's as simple as off those April lows. Tech obviously has done very, very well. We're giving a little bit back. I think there's some positive. Tech's obviously pulled back more than just about everything else here in the U.S. We've seen, some other areas hold up okay. So you got a little bit of rotation going on. We're not overly concerned. I think it just was simply a little time for a breather. And at the same time, we haven't had a lot of volatility, honestly, in the overall major indices like the Dow and the S&P. It's almost like watching paint dry, like you started the conversation, just getting ready for Powell. I guess it's tomorrow morning for us here in the U.S. But, we've had some big events from Jackson Hole before, and we'll have to buckle up and see what happens this time.
Yeah, Ryan, some Goldman traders say it's time to buy the dip in momentum stocks based on historical trends. And then UBS is saying that investors with excess concentration should maintain a more balanced exposure, given that the AI rally is also maturing. Do you expect the pain trade to continue for some time to come?
We think so. I think being more balanced is kind of the camp I'd be in. We have tech exposure for sure. But at the same time, we like to look at areas like financials and industrials. We just had earnings season overall fairly solid. We can get into that if you want. But the reality is this is more of a global bull market. Japan's at 35-year highs, right? There's a lot of different parts that are doing well. One thing I want to point out to the listeners, though, historically the second half of August into almost late October in the U.S. is, from a purely seasonal point of view, one of the weakest times, especially in a post-election year like we are here in the U.S. So you don't blindly invest in seasonality. But when I see things, it's tad geeky here, there's not a lot of participation in terms of number of stocks above their 50-day moving average and 20-day moving average. It's a little geeky. Just know there's some potential weakness under the surface. We've been talking about this for about a week now. And sure enough, stocks have been coming back a little bit. So maybe a little more volatility would be perfectly fine after nearly a 30% rally on the S&P off those April lows.
Yeah, it remains to be seen whether the recent bout of tech selling will be short-lived. Let's touch on earnings. Not so great news for Walmart. Their shares dipped more than 4% after they missed the street's expectations for quarterly earnings, the first since May 2022, by the way. They did report sales that surpassed estimates. How much of a read does this give you on consumer sentiment?
Yeah, well, listen, it gives a little bit of it. They're clearly one of the largest, if not the largest retailer in the U.S. I know they said they're doing their best to keep prices low and obviously dealing with the tariffs, the uncertainty around tariffs. And it's interesting. It's something for everybody, because when the earnings came out, they said, yes, they missed on the current quarter, but they actually increased what their sales guidance was for the whole fiscal year. So, but the reality is, what did the market say? Well, the market voted, it was disappointing with the 4% drop. I just looked, it's still up 9% on the year, so still having a solid year. I'd say, give them a C+ for this earnings. It wasn't spectacular. But the reality is, that we've seen bits and pieces of the consumer here in the U.S. showing some cracks, and this might be another potential sign. We had to me, the biggest story of the day almost was a big jump in initial jobless claims, the highest we've seen in 2 months. So people have jobs, they're feeling happy, but those are some minor little cracks. We obviously, I know you talked about this, that big revision in the jobs number we had in the U.S. a couple weeks ago. So there are some signs that the labor market has got some cracks. That's what puts Powell in such a tough spot tomorrow, because if you look at the labor market, he absolutely should be cutting interest rates, in our opinion. But then you look at inflation and what all the companies are saying, they're still feeling big pressure from tariffs and likely continued pressure coming from tariffs with potentially higher prices. So Powell's in a really tough spot, but to answer your question, put a bow on this, the consumer's okay in the U.S., but there are clearly some concerns we have here.
Yeah, there are some concerns. We still have a couple of big players set to report earnings next week. How are those looking for you?
Yeah, there's still some. NVIDIA is the big one. I don't know if they're next week. There might be 2 weeks. But nonetheless, NVIDIA is the big one. We are really near the end of earnings season. I mean, there were some retailers this week, Walmart, Home Depot, different ones. Once you get to NVIDIA, you're kind of near the end. But overall, this earnings season has been solid. S&P 500 earnings, about 82% of companies have beat on estimates, about 80% beat on revenue on the bottom line. And the reality is earnings are up about 11% year over year for the S&P 500. Now, okay, what's that mean? Well, it was expected to be 4.5% this time about 6 weeks ago. So the truth is corporate America has come in. They're very agile, continue to find ways to get people to buy things and continue to grow. But again, what are they saying about the future is clearly a little more cloudy, and that's what's kind of caught some people in a little bit of a lull here as we have had a little weakness over the last 5 or 6 days in the U.S.
Yeah, fair point. Let's come back to Fed Chair Powell's speech at Jackson Hole. Fed funds futures pricing in a nearly 74% likelihood of the central bank cutting rates at its next policy gathering in September. Is that likely to be a unanimous decision, given that we had 2 dissenters the last time around?
Wow, this is the ultimate question. Because I'll tell you, this was 100% just about a week and a half ago, right? Yeah. And literally on Friday, we were talking 90%. And now I guess the most recent number, like you just said, is 74, because we actually got some solid economic data in the U.S. this morning on manufacturing and services. So the reality is, I don't think it's going to be unanimous. I mean, we do think they're going to cut. We do think they're probably going to cut. There's a lot of pressure, obviously, to cut. And again, we think you should really pay attention to that labor force, which is potentially weakening, especially with the spike in initial jobless claims. But our base case has long been that the Fed probably cuts less than what the market's expecting. Now, this time a week ago, market was saying 3 cuts. We were saying the whole time it's probably more like 2. We do think you get 1 in September, maybe 1 in December. But again, we've got that concern that when we look at inflation, we think the Fed has an inflation problem, right? If you look at core goods, core services are starting to spike up a little bit. We had a big jump at the producer level inflation last week in the U.S., and that the worry is that'll bleed into the consumer prices. So again, the Fed, the truth is the Fed's in a tough spot. Last comment here. We were saying at the start of this year the Fed should have been cutting. The Fed had covered a cut early this year. For whatever reason, they didn't. Then the tariff stuff happened. They had to wait. So that's why the Fed's in a tough spot. And it's kind of, in our opinion, kind of their own doing, because they could have cut earlier this year, and that probably would be helping the labor market. But it's where we are right now.
Yeah, to your point, the Fed is in a tough spot. That forecast has come down from 85 to 74%, so it's certainly not set in stone just yet. Speaking of cuts, the U.S. and EU seem to have cut an agreement on the trade front, which EU Trade Commissioner Maros Sefcovic has called the most favorable trade deal the U.S. has extended to any partner. Is this relief for the EU, given previous concerns about an unbalanced deal being struck last month with 15% blanket tariffs on EU exports to the U.S.?
I think you have to say yes. We'll see how Europe responds tomorrow. But like you said, the initial reaction was not positive from the European point of view. They thought that President Trump got them, I guess, and now some back and forth and maybe a better deal for Europe, which is important, I think. I mean, but at the end of the day, I think it's just nice that we're inching closer again from the U.S. point of view to getting a lot of these big tariffs with our trading partners in alignment, right? And this is just another sign. Now, again, did markets react to this? I know you and I kind of talked about that before we went live. No. I mean, honestly, no. Today was a pretty slow, boring day. I mean, there wasn't a lot of action, so it's not like markets reacted to this. But at the same time, the markets don't like uncertainty. It's a cliche to say, but it's true. So this is nice to get out of the way. Maybe we can get Jackson Hole out of the way tomorrow, and then over the weekend, people realize, wow, we've got a good thing going with Europe here. We're getting past that. But for now, we're just so hyper-focused on Jackson Hole tomorrow. We kind of almost forgot there's a pretty good deal potentially that just took place.
Yeah, Ryan, many partners still waiting for similar clarity on the trade front. Will they feel more optimistic now that the needle has been moved, at least with the EU?
I think so. I mean, you had to get the big one out of the way, and obviously, well, Japan's a big one, EU's a big one, Korea's a big one. So we're getting some of those out of the way. So countries that haven't been there, they're kind of next in line, right? I mean, you knew the EU, you wanted that, and obviously with all the European leaders were in Washington, D.C. on, I guess it was Monday. On Monday, obviously talking about Ukraine, but at the same time, they were there, so that's not a coincidence. This has taken place. They probably had some time to talk about some other things while they're face-to-face, and now we've got these deals. But I think the reality is it's kind of a domino effect. You get the big domino out of the way, and more dominoes can fall, so more trade deals, let's just hope, are finalized and announced over the next month or so.
All right. Excellent stuff, Ryan. Thank you so much, as always, for your time and your insights. All eyes on Jackson Hole. Good luck with Fed Chair Powell's speech.
Yeah, well, we'll see. Get your popcorn ready. It's going to be interesting. But thank you for having me. I appreciate it.
All right. Appreciate your time as well. Ryan Detrick is the Chief Market Strategist at Carson Group, and you're listening to Money FM 89.3.
Before acting on the information on Money FM, please consider if it's suitable for your own investment objectives, financial situation, and risk tolerance. To listen to more great interviews, download our podcasts at audio.sg or download the audio app. That's AWEDIO, audio at the App Store and Google Play.